So last time we had gone through a few things. I'll just brief you through them, and here, well, I had some notes here. You can just look at them. Yep, mastering the skill. This was the first part, the introduction part. We did chart analysis techniques. We were supposed to have good picture of market long long term, medium term, and short term movement. Identify trend of market, that is strength of each of them. Identify important candlestick patterns information, and identify strong support and resistance levels that can help you in your entry and exit. At the end of the course, students should be able to read chart like the author and have a better understanding of the market movement and eventually win more trades. So we started with what is Forex. Forex is basically foreign exchange. It's a short form of those two words. And we went through buy and sell. We saw that if you buy a currency pair, you're expecting it to increase in value. That is, you are going long. And if you sell the currency pair, you are expecting it to decrease in value, and thus you are going short. So reasons for trading, there are two reasons for trading, that is speculation and conversion. So you may trade just to speculate the movement of the currency pairs to get profits. That's what most traders do. And you may trade to convert your money from one currency to another. That mostly happens with the tourists or maybe big companies that trade internationally. Yeah. So there are currency pairs whereby we have this part. The first part is the base currency, and then the second part is the quote currency. They are separated by a backslash, and therefore you may find currency pairs like Euro USD, Japanese Yen USD. Yeah, such stuff. Buying a currency pair is similar to buying the base currency while simultaneously shorting the quote currency. Selling short, at first we say that shorting is like selling. So selling short a currency pair is same as selling short a base currency while simultaneously buying the quote currency. So what you do it to the base currency, but do the opposite of the quote currency. Then on the currency pairs, this was the example that we looked at. So if you buy the euro for a euro USD, if you buy the euro, then you sell the USD. If you sell the euro, then you buy the USD. And if you sell the euro, you are expecting it to decrease in value. Yes. And the second part we did, we went to commodity pairs. And commodity pairs, here we say that there are some commodities that go hand in hand with the same trajectory as some currency pairs. Here we say that things like gold or oil may move relative to some currency pairs. For example, the Australian dollar / USD moves in the same trajectory as the gold, and USD CAD pair, USD and the Canadian dollar pair moves in the same trajectory as the price of oil. And then we went on ahead to look at pips, where we say these are primary units of movement for all currency pair exchange rates. And pips are divided into, pips, this is what we went through. So for example, this is a pip, and then this lower here, this is a 4, this is a fractional pip. Just a moment, let me show you what that is. So 1.2001, and let's call it a 4 cent, because that's a fraction. 0.4, let's just say 4. So this is 1 pip. So if it moves from 1.2001 to 1.2005, if this one changes to 5 and these ones retain their value, it means that it has moved up with 4 pips. Yeah, I guess that's understood. And then we went ahead to look at lots, and then we said that lots represent a fixed amount of currency. And after saying that, we say that 1 pip is 100th of a cent, and one lot is 100,000 units. One lot is equal to 100,000 units. So we say that one lot is 100,000 units of the currency you are trading. So for example here, if we are buying one standard lot, then we are buying 100,000 USDs. And so let's say that we are trading the Euro USD, and then we say that if you open at 1.2401 and you are buying, then you close at 1.7631, that is that will have moved by some units up. Then what we said is that if you had that one lot and then you convert at your opening, you'll find that you started with 124,010 USDs, and then you close at 176,310 USD. So therefore you'll have made a profit of 53,300 USD. And with the same scenario, we looked at another example whereby we were opening at 1.2401 and closing at 1.0001 while buying. So you buy at an opening of 1.2401 of a standard lot size and close at 1.0001, and then with that we saw that you opened at 124,000 USDs and closed at 100,000 USDs, therefore making a loss of 24,000. So by looking at the movement of the charts, you can know whether you make a profit or not. So let's go on to what we'll be going through today. Yeah, so this is what we had done the previous day, and now we are moving to margin and leverage. And I'll just do what we did last time. I'll open chart. Let me close these tabs in just a moment. Let me close all these tabs and then open chart GPT and Investopedia at the side. Then we see what we'll do today. Well, good luck in the lesson, and keep in touch, keep focused, and let's keep it going. We must know this. You must learn this together with me. And I'll be happy if we complete the challenge together and see how fast we can learn this and practice and start real trading. Well, welcome, be my guest. Oh, and today I have this mic here. Today I just got this mic here, this one here, and I'll be using it. So let me just connect it to the camera in just a moment. Just a moment. I hope I'm still visible in the background. Yep, that's it, done. So let's start. Margin and leverage. They say traders and brokers are only exposed to the change in market value on open positions. Yeah, that's true. You are only exposed to it when you are opening. The change in value of most currency pairs move about $1 a day. In fact, in 2011, the average value change for the Euro USD per day was $1.57. The USD Japanese yen pair average value change was only $0.88. That's not much. As a result, the retail traders are given leverage on open positions. So basically what's happening here is that they say the movement of the currency pairs is not that great, and therefore this not being so much, traders cannot make very great profits. So therefore there's need for leverage. In a moment we'll know what leverage means and margin. So let's go on. They say leverage allows traders to control large positions with a lower amount of funds. That can be good, but can also be bad. Leverage amplifies your gains as well as your losses. So it's like you're being loaned something. You're being loaned some part of money so that you make big trades, while you can make big losses or big profits because you are trading on leverage. You are leveraged some money. Average USD value of daily range in 2011. That's a table which shows in 2011 how the values changed averagely per day. Yeah, so we can see the one which moved so fast or so greatly was the Euro USD at $1.57 a day, but that's not much big. Let's go on to the next part. Let's look at an example of the effects of leverage. Many deposits. So Mary deposits 10,000 USD in her account at FXDD. She's encouraged by a strong US employment report to buy the US dollar. Since she feels the Japanese yen is too high, she buys USD JPY with the expectation that USD will appreciate against Japanese yen. So she feels Japanese yen is too high, and now she thinks since it's too high, the USD will rise against the JPY. Remember, JPY will depreciate relatively as USD rises. Mary buys a standard lot. A notional amount of $100,000 of USD JPY at a rate of 79.50. Don't mind, that's a plane passing. Mary buys a standard lot, a notional amount of $100,000 of USD at a rate of 79.50. See next page figure. So let's go and see the figure. Oh yeah, we'll move on to that. And so let's go back to this part and continue. Just a moment.